Okay, this is a quick section on how to make trading decisions in the share market. Now, just remember, this is coming from me, who's made probably the worst decisions in share market investment. So I just kind of listen to what I'm going to say, but don't actually put it in practice. The first thing you really need to do when you're looking at when to buy and sell, or actually what to buy into, is to do some research. Okay, you need to look at the history of the companies that you're working in, like, that you're looking at investing, because if they've got a history of doing really well, or a history of being cyclical where they go up and down during a year, then you'll need to buy and sell at the bottom of the cycle and then sell at the top of the cycle. Okay. The other thing that you'd have to look at is with your research as well is looking at the future prospects of the company. So are they doing stuff like a mining company? Are they expanding into something new? Are they looking at developing what they're doing, or are they kind of standing very still? If there's a future prospects there, they're possibly going to be making more capital. And if they make more capital, then you'll get a spin off with your shares. The general economy, what's happening around in the world, or what's happening with our economy, if it's really strong, are the shares going to be strong? The industry type is something that's really important to look at too. So we've just the global financial crisis has come through, and Australia's kind of weathered that storm, and that's probably down to a number of factors. But one of it is that we've got a very big mining industry at the moment, which is going very well, so that's supporting it. So if it's an industry type like mining, then maybe that's a good thing to look at, or even something like a bank or a blue chip stock, which has had a history of always being very solid. There's also the trends in the market. There might be something along the lines of maybe the environmental trend is at the moment, so you might want to invest in that kind of stuff, or those kind of things are floating around. The other thing to look at trends is what I was mentioning earlier on, is cyclical. And this is where the shares might follow a cycle during the year, and that might be because of dividends and those kind of things. So if there's a kind of a semi-predictable cycle, you might be able to buy and sell. And that also might be to do with seasons, because if it's something like fruit or veg or something like that, that maybe the seasons affect the sales as well. And another thing to also try to do is try to collect as much data as you can on your shares as well, because that's really important. Because if you have more data to have, the more informed you will be. The other thing is, what else is going on globally? Okay, because we are in a global environment, which means that if something happens overseas, it's probably going to affect us. If something happens in the US, then generally it flows on to us as well. Okay, but if not all the time, because if you look at the global financial crisis, where the states got hit very hard, we kind of weathered the storm a bit, but really we were still affected because our share market isn't as buoyant as it used to be. So when you have a look at the kind of traders that are floating around, there's some just trade for income. Okay, so all they're doing is looking at making money out of their shares, and probably making it in the fairly short term. And they're looking at a couple of types of ways of getting income. One is dividends. This is a regular income paid to you. It's a share of the profit. Okay, we've talked about this before, but you get a share of the profit because you are a shareholder, so therefore a dividend is a regular payment. And they sometimes come out 6 monthly, or they can come out in a year, but not all companies pay a dividend. But this is like an income stream for you. The dividend, so what you can do to work out whether a share is good value or not, is to have a look at the share list. Okay, that was one of the things we started this course with, was a share list. And in the share list you have a yield. Now the yield tells you your percentage return on how much you're putting in. So if it's a 10% return, if your yield is 10%, for every dollar you get put in, you're going to get 10 cents back in the form of a dividend. Okay, the franking level is another thing to pay attention to, because you have to pay tax on your dividends. Okay, but a company can pay tax on your behalf by paying the company tax. So if the shares have a very high franking level on them, so they've paid the full company tax on it, this then reduces your tax liability and can give you a bit of a tax benefit. Okay, we look at that a bit later, but dividend imputation or franking levels is important. The other thing is timing. You can, when the shares are trading along, they tend to go up a little bit before the dividends announced, and then they plop down a bit and they go up a bit. This is probably a bit exaggerated, but the principle's kind of there. Now this is called going ex-dividend, because there is a time frame between when you can buy the shares and when you're allowed to get hold of the dividends. Okay, you can't just buy the shares the day before the dividend's released. You've actually got to have them for a certain period of time, and this is set out by the company and the ASX. So there is this time lag here. So what tends to happen is people tend to buy the shares before this date comes, which pushes the prices up because there's more of a demand on it, and then it drops down after when it goes ex-dividend. So that's probably the timing as well. If you can get your timing right, so you buy it before then, hang on to them, you can sell them off after you get the dividend, and that's all cool. The other type of investor floating around is growth investors, and these are the types of people that will hold them for a longer term. Okay, so we're looking at 5 or 10 years investments rather than maybe over a year or 6 months. So what you'll be looking at then to make your decisions is the price. You're really looking at the price, and you're really looking at the year high low, because you want to see at the moment if the shares that you're buying are floating at a high or at a low. So you really want to know, are you going to be getting money out of these, because you want to see if the shares are going up or down over that yearly period. Now this is also helpful if it's long term. Remember, we're talking long term here, so we're not talking 10 months. We're probably looking maybe 5 or 10 years. The price earnings ratio is more helpful here because it gives you the relative value of the shares, whether it's underpriced or overpriced. Okay, and that's probably a good one to look at, and that's also good to look at when you're not relying on dividends, because if you rely, your price earnings ratio is given to you for companies that don't release a dividend, and sometimes those longer term ones, you're not interested in that dividend, you're looking at that price earning ratio. Timing, look at the tax rules and the capital gains tax for these ones. If you hold them over 12 months, you get to halve your tax. Okay, so that's why that longer term investment for growth investors is more important, because they're going to hold it for more than a year, and therefore they get that tax benefit there. The other thing to pay attention is the news, and once again we're talking about this kind of research into what's going on. So the news is what's going on, which is the industry news, what's happening to that specific company or other things that are happening in the market. So once again, it's research, and depending on what you're trying to invest, how you're going to invest, whether you're just looking for that income or whether you're looking for that long-term gain, there's probably 2 or 3 different strategies. The other thing I'd like to show you is just the length of investment, short-term versus long-term. Over here we have the first graph on the left here is BHP, but notice it's only over a few months here. So it's really only about a 6-month period. So, and you can see the daily up and down price. So if you look at it, you think, oh my goodness, it's not a very good investment, because look, if I buy them here, that's what they are. But now they're right down here. I mean, they've gone from around about, $37 down to about 34 roughly. So you think, oh crikey, that's not a good thing. But when you actually zoom back and look at the long term, remember we're talking longer term, we want to look at the longer term of what's going on. You can see that this 6 months is really just this little bit in here. So you're hanging in here, whereas if you look at it all the way across, that's pretty cool. So if you got them back here in 2003 for $10 and even sold them at the lowest point now, which is at say 35, you're still way ahead. So that long-term versus short-term investment is really important to pay attention to as well. But you have to be informed. You've got to know what's going on in the market, and you've got to know where that break-even point is so that you can buy and sell without making too much of a loss.